Good afternoon, everybody. Welcome to the Sierra Pacific Financial Advisors 2023 Economic Outlook and Forecast. We appreciate your time this afternoon. So before we get started, I'll introduce our guest speaker today. Just a couple of housekeeping items. Everybody is, of course, muted with no video. There is no chat. If you wish to ask us a question, please use the Q&A button down on the bottom of your webinar screen. We'll be sure to be taking questions. There will be an opportunity to take questions kind of throughout the presentation, but also we have a section set up at the very end of the presentation today for the bulk of today's questions. So without further ado, Bryce Gill is our guest speaker today. And Bryce is an economist, and he's part of the First Trust economics team that Bloomberg has raised as one of the top forecasters of the U.S. economy over the past several years. At First Trust, Bryce is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust economics blog. He is also one of First Trust national speakers, traveling around the U.S. to present timely information on the economy and financial markets to both professional and everyday investors. Cogent's 2017 survey of advisors rated First Trust thought leadership material as #1 for most read and most shared by financial professionals and colleagues or clients. So Bryce is based out of the Austin, Texas office of First Trust. He received his MBA from the University of Texas McCombs School of Business, and he has a BA in economics from Miami University, Ohio. And with all of that, I will now turn the presentation over to Bryce Gill. Bryce, it's all yours, my friend.
All right. Well, hey, thank you so much for the introduction. And thanks for having me here today. It's great to be with everybody. Man, I wish I was in Austin, Texas right now. I just did the drive from Ann Arbor, Michigan to the suburbs of Chicago, drove through a snowstorm, which I am not used to doing anymore. I'm originally from here, but it's been a while since I've dealt with that kind of weather. So I'm hoping things are better for everybody on the call here in California. I'm glad I made it here safely so we could do this call with everyone because, hey, it's been a crazy couple of years in the financial markets, and especially starting last year, some big challenges and volatility has once again become a fact of life, right? And last year, it was the first year, only calendar year I could find where both stocks and bonds were both down over 10%. And really the context behind everything that we're dealing with is this inflationary surge that's occurring in the United States, which everybody's familiar with at this point. But early last year, sometimes it's interesting to think back to what the narrative was. The idea was, hey, this was all going to be temporary or transitory, and it wasn't going to be that big of a deal. It was just kind of a short-term thing. Well, hey, the markets finally realized this wasn't any of those things. It's going to stick around, and the Federal Reserve had to start hiking interest rates at probably the fastest pace since the Paul Volcker days. The last time we saw inflation, like this was the 1970s, about 40 years ago. So, hey, anytime interest rates start to surge, that has big implications for financial asset values. Interest rates and earnings are the two big variables that go into, the pricing of financial assets. So there's some good news, guys, and we'll go through that today. I think a lot of the good news is actually on the inflation front. I think we're going to see some good progress on that this year. We already have been seeing progress. There's some challenges ahead of us as well, so I'll talk about those. And I just want to wrap things up with sort of a big picture overview about why the United States is probably likely to stay on top here as an economic superpower. I don't think we're going to get displaced by China or taken over anytime soon. All right, so with that, Daniel, if you want to go to that first slide on the money supply for me, let's get into it. Let's talk a little bit about what's going on out there. And, let's start with the good news, like I mentioned, and, we'll start with inflation because like I said earlier, hey, this is the context of everything that we're dealing with in the markets today with regards to volatility and interest rate hikes and everything else. There was this idea after the 08-09 financial crisis that we had banished inflation to the dustbin of history, and we've like evolved as a species or something, and it could never happen again. And for good reason. People felt confident because, hey, after 08, 09, a lot of economists, I'm thankfully not included among them, but a lot of market participants, whoever else, were calling for hyperinflation when the Federal Reserve started to do its quantitative easing program, right? They were printing a lot of money. But we now look back at those days and say, hey, there was no hyperinflation. And I think the big reason why so many people got it wrong back then is they were assuming the Fed printing money, all those dollars were getting out into people's hands. And they weren't. They were printing a lot of dollars, but we used them to put in bank reserves or use them for Dodd-Frank capital ratios, right? Shoring up the banks during the financial crisis. The money never really got out into people's hands, so they couldn't really spend it. And this is a really crucial distinction. So I think looking at the Fed's balance sheet is the wrong thing to do. Instead, what I would recommend is looking at what I call the M2 money supply, which is the chart that I have here, okay? And I've just done the growth rate year over year, so we can see how fast the amount of dollars in people's hands are growing, right? And so what is M2? Why should you care about this? This is what I call high-powered money. It's checking account balances, savings account balances. It's dollars that people can go out and spend, okay? And so if we look at 2008, 2009, nothing really notable happens during that era because, like I mentioned, hey, we stashed it all away in bank reserves. Well, the COVID pandemic was very different. We printed up about $5 trillion. And, for context, because when numbers get so big, I think they lose meaning. $5 trillion is about what we spent on all of World War II when you adjust for inflation over time. So we're talking about a staggering amount of money. And we went direct to consumers with it, right? We sent stimulus checks, boosted unemployment benefits, PPP loans. And that's what you're seeing on the chart here, the growth rate of the M2 money supply. Okay, it leaps off the page at you. During the pandemic era, we saw by far the fastest growth rate in high-powered money in modern U.S. history. And so I would argue this has been a big tailwind for the inflation that we've seen. It's a big reason why inflation has gotten to a 40-year high. Now, there is good news. And the good news is the Federal Reserve has taken action on this, right? They've raised interest rates. We've stopped sending out stimulus checks. We've tightened monetary policy. And the result has been a rapid decrease in the growth rate of the money supply. In fact, for the first time in modern U.S. history, the money supply is almost at 0%, right? So it's barely grown at all in the past year. And so, hey, what this tells me is we can expect some more progress on inflation. We're starting to already see that. Last month's data, we saw prices actually fall month over month for the first time in 32 months. Inflation is moderated from about 9% at its peak to about 6.5%. I think we should expect more progress this year. And that's the biggest thing that everybody wants to see, because progress means the Federal Reserve doesn't have to keep raising interest rates at such a rapid pace, right? So I think we are getting towards the end of this Fed rate hiking cycle. The worry, I don't think, is going to be so much on the inflation or the interest rate side of things, at least in 2023. And we'll talk about some longer term challenges in this presentation with inflation. I think the worry is going to be on like the earnings or the recession side of things. And we'll talk about that too. So some good news here, but don't expect us to get back to 2% here in the short term. I'll talk about why here in a couple slides. So Danielle, if you want to go to the next one here. Let's talk really quick, guys, about another big advantage that the United States has with regards to the inflation situation around the world and also the geopolitical situation around the world, okay? And something also, I guess it's worth mentioning, that's the polar opposite of the 1970s, the last time inflation was as high as it is today, okay? And that's the situation around U.S. energy production. So, why are we talking about energy production? Well, energy, especially when we're discussing inflation, is a crucial thing to look at because energy is a unique good. It goes into every other good and service that we purchase, right? And so, hey, energy, it typically is at the center of every inflationary crisis. And when we think about the 1970s and you picture that era in your head, most people have the exact same image, which is gas lines, right? The United States was having a massive energy crisis in the 1970s. And to just sort of chart the history of U.S. energy production and sort of I guess what you'd call like international dependence or the energy situation in general. What I like to look at is the U.S. energy trade balance. This is just the dollar value of our exports of energy minus the dollar value of our imports. And the insight to this is, hey, if we import more than we export, well, we're on net dependent on somebody else for energy, and they can use that as leverage over us, right? Just like the OPEC did in the 1970s. And if you look at the chart here, hey, we were importing more than we were exporting back in the 1970s. And the U.S. energy trade deficit grows over time. For about 50 years, it's negative, culminating right around 2008, 2009, the big financial crisis. It's really where we saw the peak of things happen. But then something changes in 2014, 2013, roughly, and that's the widespread adoption of hydraulic fracturing technology in the United States. All of a sudden, all of the shale oil and gas that we've known was there for over 100 years, we just didn't have a good way of getting it, becomes economical to produce. And you see very rapidly, hey, the United States goes from its largest energy trade deficit in history to being a net exporter of energy, which is where we're at today. And so, hey, this is important because not only does it sort of give us some inflation insurance, right? Our inflation rate isn't going to be as high as other places around the world, specifically Europe, right? They're the ones having the energy crisis today, not us. What it also allows us to do is, hey, we're the ones with the leverage on the energy sector these days, right? And we can kind of step in and come to the rescue of some of our European allies after this war in Ukraine erupted and disrupted energy flows to Western Europe. So basically a big advantage that the United States has, a polar opposite situation to the 1970s. I think if, hey, this war in Ukraine had kicked off 10 years ago, this would be a totally different story, right? We would not have the production spun up, and the Russians would have, frankly, a lot more leverage than they have today. So this really is helping the situation, at least regarding the United States and our Western European allies. So that's some good news right there on inflation as well. Let's talk, Daniel, about the challenges that I see regarding the inflation picture. And I guess it's kind of right along the same lines of geopolitics, and really, I think the big challenge here is all about globalization, or really deglobalization, and what I think is going to be the long-term implications when we look back 10 years from now on the COVID lockdowns. I think people are going to look at that period and think of massive supply chain issues, and also, hey, the fact that the United States needs to become more self-sufficient, right? And we're already beginning to see this happen. And so what I've done on the screen here, just to show you globalization over time, I've added up imports and exports for the United States. I adjusted all this data for inflation numbers as well. So what you're looking at is the actual volume of goods crossing the US border. And, hey, why do we care about globalization here? There's obviously downsides. We've lived through those the past couple of years. But the upside for globalization, what it does really well, is it makes things cheap, right? It makes things affordable. And so ever since the Great Depression, when trade bottoms and around the 1930s, globalization has been rising for the United States. It's probably the most long-term trend that's been around for the U.S. economy that I can think of. Now, there's bumps along the way, but big picture, it's been this reliable deflationary force sort of behind the scenes, keeping a lid on consumer prices. And all this, kind of comes to an end after 08, 09, things level off. We've been at plateaued ever since. But I think it's very likely in the aftermath of COVID shutdowns that have disrupted all these supply chains, now the war in Ukraine, which has shut off trade with, frankly, a third of the planet for the United States, we're going to see globalization go into decline to some extent, okay? Now, the upside of that for us as a country is, hey, we start making more semiconductors here, right? Or, some more medical supplies here, or pharmaceuticals here. We're less reliant on certain critical industries, because that's really what's going to come back to the country. We're not going to make furniture or textiles again. But critical industries are migrating back to the U.S. pretty rapidly here. But the downside is it's just going to be more expensive for some of the stuff to be produced domestically than abroad, right? And so, hey, as deglobalization occurs, I think that's the big challenge to getting back to that 2% inflation number. I really do think 2%, and everybody, that's just the Fed's status quo number. That's their target. That's what they want to get back to. Inflation's been low and stable around 2% for 40 years or so, ever since Paul Volcker got out of office at the Federal Reserve. And when you think about that period of time, well, right around after Paul Volcker left the Federal Reserve, the Soviet Union collapsed and started trading with the West. Half the world, essentially joins our markets. Major deflationary force. 10 years after that, China joins the WTO, the World Trade Organization, starts producing consumer goods en masse with very affordable labor, right? Both those things are sort of reversing now. And I think this is going to have long-term implications for getting back to that 2% price level. Now, hey, even if it's not the US making everything, right? Because we're not going to start making a lot of this stuff. I think you are going to see a lot of things come closer to home. So maybe if we don't make it in China, maybe we make it in Mexico, right? Or, maybe instead of making, iPhones in Beijing or in the industrial areas over there, maybe they migrate to India instead, right? Places that have less political instability, but are a little bit more reliable. This is going to be, I think, a big trend going forward. You're already seeing the government step in and subsidize a lot of this with the CHIPS Act, and the Inflation Reduction Act would be another example. Did it lower headline inflation? No, it was just a bunch of more money on the furnace, right? Probably overall puts upward pressure on inflation short term, but the goal of it is to reshore a bunch of critical industries to the United States. That really is kind of the idea behind it. So longer term, hey, if transition us faster to being self-sufficient in some of this stuff, maybe it's deflationary 5-10 years from now. Today, probably not. So Dana, if you want to go to the next slide, I think that's the chart we have on the green energy industry. And so this is a great example when I talk about strategic industries migrating back to the United States. I think green energy is a great example. The Inflation Reduction Act mostly put money towards reshoring manufacturing in the green energy sector. Okay. And so, hey, why are we seeing so much effort to try and bring some production back to the country with regards to green energy? Well, first of all, like I talked with on the trade deficit and energy slide, right? Energy is always a critical industry. It goes into every good and service that we buy. But also, I think, you're seeing a lot of politicians in Washington and probably also defense officials look at what's happened with this Russian invasion of Ukraine and the fact that Russia was able to use leverage with regards to energy against Western Europe. And they're saying, hey, if we do this big green energy transition and we don't produce any of this stuff for ourselves, it's all produced abroad, what's to stop a similar thing from happening to us? Okay. And when you look at the realities of the green energy supply chain, you can see why they're worried and why we are making such a big effort as a country to bring manufacturing back home domestically. Okay. And so what I've done here, this is all data from the International Energy Agency, by the way. I've just pulled data on the top 5 inputs to green energy. So things like lithium ion batteries, solar panels, windmills. The left side of your screen is where we dig these commodities out of the ground, okay? And the right side of the screen is where we turn those commodities into final goods. Where do we process lithium into a functional lithium ion battery? And so, hey, if you look at the left side of the screen, the biggest takeaway is just that the United States doesn't really produce a lot of these commodities, right? Frankly, we are probably the most well-endowed country with natural resources in the world. But these are some of the certain things that we don't really have in the ground domestically. And there's not much we can really do about that, right? We can't magically all of a sudden have a bunch of copper in the United States. However, if you look at the right side of the screen, it's a very big trend here. And the trend is that, China basically dominates the whole supply chain for producing the final green energy goods, right? The actual windmills, solar panels, lithium ion batteries. And so that's where we can take action. That's why you're seeing so much money poured into this. There's national security concerns around China, right? It's the same reason we're bringing semiconductors back. People are worried about them invading Taiwan. This is another area we're exposed. So geopolitics is really coming into effect here. It's a big reason why you're starting to see reshoring happen. And I think green energy is another one of those industries where you're going to see a big effort made to bring production back to the United States. So, hey, downside is, again, it makes it more difficult to get back to 2% inflation. Upside is, hey, if we're decarbonizing the grid, in the future, we don't really have to worry about, potentially hostile actors using the supply chain as a weapon against us. So, Daniel, I think that's enough covering the inflation side of things. Yeah, thank you. Perfect. So, guys, the big picture is expect more progress this year. A lot of the issues with inflation, they're going to stick around, but this year is not going to be so much a concern about inflation or interest rates. There's going to be progress that's made. The Fed, I think, is getting towards the end of its rate hiking cycle. And by the way, they can only fix the too much money issue, right? They can't solve supply chains or globalization or wars abroad. And so those things are really going to be up to our country to invest and kind of build domestic capacity. And to a degree, that is happening in a pretty rapid fashion here. So, hey, more progress, but probably not back at 2% this year. I'd say 4 to 5% is probably a better guess for inflation by the end of 2023. So we kind of covered the inflation picture. So let's talk about why the concern, at least in our opinion at First Trust, for more volatility in 2023 in the markets isn't really on the interest rate or the inflation side of things. It's more on the worries about recession and the impact they could have on corporate profits. Okay. And so, last year, if you remember, we had 2 negative quarters of GDP growth, right? And that's the rule of thumb for a recession. It's what most people in their minds kind of think of a recession as. And at the time when it happened, at First Trust, we were making the argument, listen, we get that this is a rule of thumb, but we don't think that the country is in a recession. And we think the economy is going to continue to expand in 2022. And there was individual, variables that I could cite, right? The labor market was adding back jobs. People were going out and spending money. Corporate profits were rising. Industrial production was rising. Daniel, I think we went back a couple there. Yeah, perfect. But I'll just talk to you about the big picture, the reason why we felt pretty confident there wasn't going to be a recession last year, because it's the same reason why we're worried about one this year. And really, it comes down to the shift in consumer preferences that happened during the COVID pandemic, okay? And so that's the chart that I have on the screen here. I've just got consumer spending. I've broken it into the 2 big buckets. One is goods spending. The other is spending on services. I've adjusted all this data for inflation. And then on top of that, hey, I added some trend lines there. Okay. Now, what are the trend lines for? They really are just there to kind of give us a good idea of what normal would be in both these spending categories. So, hey, it's not a perfect approximation, but where would spending on goods and services be if the pandemic had not happened and we just all kind of continued on with our normal lives over the past 3 years or so? And so, hey, 2020 hits, this pandemic erupts, we have lockdowns all over the country. Consumer preferences changed in an extremely rapid way, right? Probably the fastest in US history. The pandemic mostly affected services, right? We couldn't go to restaurants or bars or go to a football game or, you name it in the service sector. And hey, we see services drop off a cliff, right? Nobody's spending money on services. At the same time, hey, everybody's stuck at home. They're buying stuff off of Amazon, right? So goods spending surges well above the long-term trend line. Now, last year in 2022, we were well into the reopening of the economy. There was no one that was really shut down anymore. Vaccines were out there. They were widely available. And what you'd expect to happen started to happen, which is people started shifting their consumption preferences back towards what normal, quote unquote, would be, right? And so, hey, services are recovering and spending on goods has been falling fairly consistently. Now, in 2022, this recovery was still underway. And so we said, hey, listen, you're going to see a lot of layoff announcements at big companies, but specifically, they're mostly going to be in the goods sector, right? Like Pepsi or Target or Walmart, just because, hey, there's less people out there buying goods. Everybody's shifted back to buying services or going on vacation or taking a cruise or going to a football game, right? And so big picture was, yeah, you're going to see a lot of headlines, but the service sector is a bigger part of the U.S. economy. It's still recovering. It can keep the overall economy growing, even though even though goods has been falling. So, and by the way, I think we were right about that. Q3 GDP was positive, and this morning we just got Q4 GDP numbers, which were also positive. The economy did grow in 2022, and so, services kind of bailed us out last year, right? People were still getting back to normal. Well, now you look at this picture, and it's pretty different, right? As we head into 2023, goods spending is still well above that long-term trend line. It has further to fall to get back to quote unquote normal, while services spending has mostly recovered to its long-term trend, to where it would have been if this pandemic had not occurred. And so at this point, I don't think we can rely on services to reliably bail out the US economy like they did last year in 2022. And what this ultimately means is, hey, services can't absorb job losses in goods. So the unemployment rate probably does rise modestly here in 2023. Now, I don't want to oversell this recession that I'm forecasting here. There's a lot of recency bias when we think about recessions in the United States to extremely significant negative events, right? 0809 was the worst recession since the Great Depression, slowest recovery since the Great Depression. Then you have the COVID pandemic, which is an unprecedented event from an economic perspective. That's not what I'm forecasting here at all. I don't think the wheels are about to come off the bus. I don't think, the economy is about to fall apart. Really, it's just a normalization that's occurring that's been 2 years in the making, right? We're just getting back to normal. It's the negative effects of all the stimulus and the shutdowns and the shift in consumer preferences is finally going to make itself known. Overall, I expect a rather moderate and short-lived recession, but it is going to be a recession nonetheless. The result is probably about a 10 to 15% decline in profits this year. And so, hey, interest rates, we've probably seen those rise mostly as much as they're going to rise. All right, I don't expect another big surge in interest rates this year, but I do expect a decline in profits. And when you put those two things together, and we use a stock valuation model called the capitalized profits model, what we get for the year end is about 3,900 on the S&P 500, but probably a low of around 3,400, 3,300 middle of this year as the market starts to sniff out some of this recessionary data on the way. And, I've given you sort of the macro picture here. And so let's talk about a couple of those indicators that are starting to tell us. I've got a little bit more on the recession one there, Daniel, and then we'll go to the big picture. So there's a couple examples here of weakening economic data that's pointing towards a recession, right? The labor market, we're adding back jobs, headline numbers, but the number of hours worked has been falling. So we're replacing full-time jobs with part-time jobs. ISM manufacturing and services are both in contraction, which is typically a leading indicator. And one of our favorite at First Trust that we've been using, I think my boss started using this in the 1980s actually, is sales of heavy trucks. So think like tractor trailers, right? Semi-trucks. Something about these semi-truck drivers, they know when recessions are on the way and they pull back on purchases, right? And so last month, December, we saw the largest monthly decline in nearly 20 years in heavy truck sales. And so it looks like there's some cracks starting to emerge. Tells me recession probably around the middle of the year. That's probably when you see the markets hit bottom, and then I think they bounce through the end of the year. So overall, we kind of end the year flat, but there's going to be volatility along the way. So Daniel, I think we're ready for the next one here. And so, hey, I've just given you all, a bunch of, I guess, bad news, right? We're expecting a recession here, and we've got all these challenges around inflation, and sounds like a reason to run for the hills, or stash a bunch of cash under your mattress, or buy gold or something like that. And so, why am I not going to recommend that? Why am I saying stay invested, specifically in the United States? And that's what I want to finish on. It's just, anytime I talk about volatility or short-term challenges, I like to talk about the big picture, the reason why I like the United States as an investment location. And frankly, when I look around the world, I don't see anybody that can compete with us to a significant degree. And there's a whole host of positives about the United States long term. Okay. But the one I'm going to focus on here specifically is the demographic situation, because there's a lot of interesting things happening on the demographics front all around the world. And when you look at the United States in comparison, hey, we look pretty good. Okay. And so this is the working age population. So everybody 15 to 64, and what I would call us and our major like competitor countries, right? And I know Europe's not a country, but I'm just going to include them as one place. All right. So Europe, US, China, Japan, and India. So demographics, guys, are not sexy. They're not going to ever be the front page story on the news. But as an economist, I think demographics are really, frankly, the best and most reliable way we have of predicting the future from an empirical perspective with any degree of reasonable accuracy. And so, why is that? Well, hey, GDP growth, okay, the size of the economy and how fast the economy is growing, it really comes down to two major factors. One is the growth rate in your population. The other is the growth rate in productivity. Now, nobody knows how to measure productivity or forecast productivity or innovation over time, right? I've never met anybody or seen anybody that can do that. But what we can do is make reasonable assumptions about births and deaths and life expectancy and immigration, and have a reasonable idea of how many people are going to be around in each place in the future, okay? And so I'll start with Japan here. Most people kind of know the story of Japan. They were the rising Asian power. They were taking over the world in the 1980s. They're buying all the real estate in Manhattan. If you went to business school in the 80s, you were learning Japanese management tactics. And then, hey, the 1990s hit, and Japanese economy and markets sort of hit a brick wall, and it's been a tale of stagnation ever since. Well, this lines up almost perfectly with the peak in Japanese demographics. That's the yellow line up there. Their demographics have been declining ever since. Similar story with Europe. And this is, I'm just using them all together, right? It's different for every country. But big picture, hey, European demographics hit a peak in 08, 09 during that financial crisis, right around the same period. Demographics there have been in decline as well. I think it's a big reason, by the way, why European equities have kind of underperformed the past decade or so. The big one that everybody's super concerned about today is China, right? China is the second largest economy in the world. People are very worried about them displacing the United States and becoming the new superpower and things like that. And I find this very unlikely to happen, okay? And the reason why is we had a lot of better things to be thinking about in 2020, but hey, that was also the year that Chinese demographics hit their peak. They've been declining the past couple of years. Last week, I saw this has started to make it in the mainstream news. It was reported that China's population declined for the first time in 60 years. You're going to see a lot more headlines like that going forward because their population is set to decline through the end of the century. A lot of this is due to things like the one-child policy, right, and other centrally planned fertility things that are now coming around to sort of bite them. And hey, how's China seen 10% plus GDP growth for let's say 4 or 5 decades? It's very impressive. I mean, it's the fastest growth rate in the world. Okay, well, a lot of it just has to do with those two factors that go into GDP. One is they had booming demographics, and the other is they were able to import technology from the rest of the world. Well, now the demographics are in decline, and China's in a massive trade war, not just with the United States. And we sort of forget that this is still going on now that Donald Trump's out of office, but all those tariffs are still in place. Joe Biden's actually been adding trade sanctions, not removing them. He's outright banned the export of semiconductor manufacturing technology to the Chinese. And now our allies are hopping on board as well. Japan has embargoed sales of this stuff. I think I saw Denmark is now doing it as well. So, hey, massive trade war. They're not going to be able to import technology as easily anymore either. So on both fronts, demographics and productivity growth, hey, it's going to be pretty hard to see 10% GDP growth anymore, right? So I think China's in for some trouble here economically. And you're seeing that, with things like Evergrande and the COVID shutdowns as well over there. So one country that has a huge opportunity here is India. I've added them in here. They have a huge demographic boom that's going to last for the next, probably 50 years or so. But the United States is obviously the standout here, guys. Really slow and steady wins the race sort of idea here. Fertility rates in the United States are below replacement level. They're the highest in the developed world, but hey, they're still below replacement. So why is the working age population growing here? Well, it's immigration that's making up the difference, right? In absolute numbers, more people come to the United States than anywhere else in the world. More people want to come here than anywhere else in the world. Can we predict that perfectly through 2100? No, probably. But it is a big macroeconomic advantage for the United States, whatever you think of immigration policies or anything else, at least from a GDP growth perspective, it is something that kind of gives us a leg up on our competition, right? And hey, on top of that, innovation, we're the innovators for the whole world as well. No one can really hold a candle to us on that either. Something you all out in California know well. And so, hey, GDP is going to continue to grow for the United States into the foreseeable future. And as investors, we should care about that because GDP growth is very correlated to revenue growth, which is correlated to earnings growth. And so, hey, there's just going to be more people around that are buying things, which means profits are going to go up. And so if you invest in US assets, the profits that you're buying a future stream of are going to go up as well. And so I think the United States remains, when I look around the world, the best place fundamentally to be invested. I don't see anybody else out there that's about to displace us as the superpower. The dollar probably is going to remain the reserve currency for some of the reasons I've sort of illustrated on this chart. So there is actually some pretty good news here. We're going through some volatility, no question about it. But the long-term picture is actually overall quite positive for the United States. So, Daniel, I'll go ahead and wrap up my prepared comments there. And, I know you have a couple things to say. And then if we have any questions from the audience, I'd be happy to take some of those.
Thanks a lot, Bryce. So yeah, thank you for all of that. Was a really great presentation. So just a little bit about Sierra Pacific. We are a holistic financial planning and wealth management firm. We don't just focus on investment management, but if you look at the graphic we have here, we look at retirement planning, tax planning, of course, living in the Bay Area. We have clients with stock options, RSUs, ISOs. We have some very good expertise in helping our clients with those. College funding, risk management, and then for those who want to look at some charitable gifting and how can we manage estate taxes, we have good tools to help people with that. And then for small and medium business owners, we also have a business-to-business component with our corporate retirement solutions. That's becoming a more larger section of our business. So we're really looking forward to working with more business owners and helping them plan their own retirement as well as the retirement of their employees. So very much a well-rounded suite of services that we offer at Sierra Pacific. So one of the things here at Sierra Pacific, financial literacy really is our passion. And so to get that out there, we offer complimentary webinars on a bi-monthly basis. And again, we want to thank Bryce Gill for kicking us off this year in January. So they're every other month. So March, we're looking at tax planning, and especially we're going to look at the Secure Act 2.0. So Congress kind of snuck that in at the end of the year. So there's some good things about that, especially for you folks that have 529 plans for your kids. There's actually a neat little provision in there where you can now actually take leftover 529 money and put it into a Roth IRA. So we'll talk about cool stuff like that. May, for those of you that have concentrated stock positions because of restricted stock units or ISOs, or just you've collected a whole lot of intel over the course of your working career, we're going to look at ways to manage a concentrated stock position as well. July is going to be long-term care month. So, as the aging population continues, and that was a great graphic that Bryce had there, you can see how the population continues to grow. But that's some potential medical issues. So in July's webinar, we'll look at long-term care options for around insurance and how you might self-fund that. September is direct index investing. This is a new way to get into the market, and rather than have just one mutual fund with a whole bunch of stocks, kind of flips it on its head. Now you've got a whole bunch of stocks that actually help to manage tax burden. And so we're going to look at that and how direct index investing is now available to not just the big time high net worth investors, but now it's open up to just about everybody. And then we'll close the year in November. We'll look at market cycles. And again, if we refer back to Bryce's presentation, probably at the end of the year, we'll start seeing coming out of what, again, I agree with Bryce. I think middle of the year, we'll probably see some recession. And then, we come into November, we should see everything start to pop up again. So that'll be a good timing around market cycles. So with all that being said, we're going to go ahead. If there's any questions from the participants, we'll, for Bryce or myself, we'll be willing to take those questions. And just know at Sierra Pacific, we have 3 locations in Pleasanton, Cupertino, and Oakland for our clients and prospects and folks we'd like to meet all around the Bay Area. So in terms of questions, so Bryce, one of the questions that came in was, what about real estate market opportunities in 2023? What does that look like from this macroeconomic perspective?
Yeah, it's a great question. We actually just got housing market data this morning that I wrote about on new home sales. And what's interesting is it looks like we're finally starting to see sales activity sort of hit a bottom and flatten out. And the biggest thing that's going on here is less fear about perpetual interest rates, interest rate hikes from the Federal Reserve. And so you've seen mortgage rates fall by about 100 basis points. They're still high, right? Still 6%. So that's nothing to laugh at, obviously. But things are, again, moving in the right direction, right? And so, hey, that's starting to make people a little less worried. You're starting to see people get back out there into the market. Housing prices in general have fallen around the country by about 5%. So I don't expect like a huge decline in prices overall. The big issue is that there's a big shortage of inventories out there, right? Everybody got mortgage rates at 3% during the pandemic, fixed for 30 years. There's not this huge amount of adjustable rate mortgages that are resetting like in the 08-09 financial crisis, or people that are underwater on their homes and willing to walk away and leave the keys with the bank. So mostly things are just kind of in a deep freeze here. If you have a bunch of cash to put to work, I think there's certainly some deals that are starting to emerge. But overall, I think we're starting to see some signs of life as mortgage rates moderate. Keep in mind, you can always buy something and refinance in the future, right? I think we are probably years away from anything like a 3% mortgage rate still.
So that's a great question leading into what do you think the Fed's going to do? I know the Federal Open Market Committee is meeting later this month, and then I think again in March. What do you see near term and kind of as the year progresses from the Fed?
Yeah, so on one hand, hey, we're seeing inflation moderate, so that takes a lot of pressure off of the Federal Reserve. I think we're getting towards the end of what we would call like the terminal rate, the highest level that they get to. My guess is that would be between like 4.5% and 5%. So the days of 75 basis point rate hikes every meeting, those are behind us already. I think they're already slowing down a lot. And if we're both right, Daniel, about a recession showing up in 2023, I've made the case why I think one is going to happen here. It's important to remember the Fed has a dual mandate, right? They care about unemployment and they care about inflation. And so what's interesting is there hasn't really been a trade-off in that dual mandate, meaning they've been hiking interest rates very rapidly, but we've still been adding back jobs in the labor market overall. And I mentioned a couple of things there that don't look great underneath the surface, but big picture labor market looks fine still. And so there just hasn't been a trade-off to their rate hikes. I think once we start to see unemployment tick higher, that's when you probably see the Fed ultimately pause and potentially even, cut rates by a small amount. I wouldn't expect us to go back to 0% by any means, but I think, we could even see a couple 25 basis point rate cuts by the end of the year, potentially.
All right, great. So we had another question come in. What do you think about the China threat to our future economy in terms of like maybe blockading of Taiwan, for example, or limiting of export of pharmaceuticals made in China?
Yeah, I know. I think it's a 100% a valid concern. And it's something that as Americans, we have not had to deal with any time in the recent past, right? Trade has been free and open and very easy, probably since the collapse of the Soviet Union, not really a concern. That's what you see on that globalization chart. Well, now all of a sudden, hey, there's this other rising power out there that, you know, looks willing to potentially use trade and supply chains as a weapon against us. And, we're very exposed in some of these critical industries. It's one thing if we can't, buy plastic water bottles or yoga pants or something, right? Everybody can kind of live. Hey, if we can't get semiconductors, basically every consumer product and like defense goods as well aren't able to be produced. The entire economy kind of comes to a grinding halt. And so, yeah, I think fears around China and potentially using supply chains as a weapon against us are absolutely valid, and that's why you're seeing the government take action here. It's what we call industrial policy in economics, trying to bring production back to the country through like federal incentives. So the CHIPS Act, for example, right, bringing semiconductors back home. I can think of like 5 manufacturing facilities for semiconductors going up all around the country right now, bringing back pharmaceuticals, the green energy supply chain. Some of these critical industries are coming home, and it's all about national security concerns.
All right. So speaking of like things international, any idea or any perspective on like international markets, like developed foreign markets, stuff like that?
Yeah, I mean, my favorite when I look around the world, I'd say there's like 2. And Daniel, you mentioned before we even started the friend shoring trend,
Yeah,
right?
yeah.
Basically, hey, we're not bringing it home necessarily, but we're at least bringing it closer to home, or it's at least countries that we can kind of trust more. And the 2 that right off the top of my head I think of are India, and I talked about their demographics too. So it's not just geopolitics. Demographically, they look pretty good. And oh, by the way, they're the largest English speaking country outside of the West in the world, right? So another advantage there, great access to ports and shipping and all that too. But also Mexico as well. So those would be a couple places that I could think of off the top of my head I like from an international perspective. Maybe some of these other like major commodity producers like Brazil potentially. But the developed markets abroad like Europe, I think Europe's having a ton of trouble right now. Obviously, a huge energy crisis. It looks like they lucked out, by the way, and are having a warmer than expected winter. So, hey, again, some of the leverage that the Russians were hoping to use hasn't shown up. So that's good news, obviously, for the Europeans. But yeah, I think India and Mexico really are kind of my strongest conviction from like if I was going to choose like an entire country to invest in. Those look pretty good to me.
Okay. And then we both talked about recession a little bit, but assuming that we are going to have some kind of recession this year, and that inflation will probably recede somewhat, are commodities a good place to be, do you think, in 2023?
Yeah, it's a great question. So I've been recommending commodities since the middle of 2020. I think commodities are still a good place to be. For a couple of reasons. All right. One is, hey, yes, the United States is going to have a recession, but at the same time, China's reopening, right? They're the biggest demander of commodities in the world. And so, yeah, our demand for commodities probably falls somewhat here, but if that effect's going to get swamped by international demand. So overall, and all these things are a market price, right? That's global. So that's good for commodity prices. The fact that the US dollar is starting to weaken as we get towards the end of these rate hikes, a really strong surging US dollar held back commodity prices, which are all priced in dollars last year. I expect that to reverse to some degree as well. So yeah, in general, okay, from like a strategic investment, I guess, position here, commodities make sense. Real assets in general make sense in periods of higher than expected inflation. We're clearly are in one of those. I don't think commodities are going to boom for the next like 20 years or anything. But inflation, I think, is going to remain durably above that 2% target. Commodities are very volatile. I'd recommend buying a broad basket. I don't know how to trade the price of gold or like oil, right? But if you buy a big broad basket of them, you're probably going to do okay. It's portfolio insurance against inflation. Empirically, they do well during times of high inflation. everybody's looking to get some exposure into like alternative basket of assets because stocks and bonds have been under pressure. Commodities are good for that too. So overall, yes, I like commodities. I think it's a good place to be here, just from a hedging or like an inflation perspective.
Okay. And then what looks to be our last question for today is the big question: growth stocks versus value stocks. What do you think?
Yeah, I mean, it is. It's the biggest question. And I think we're in essentially the mirror image situation of the decade after 0809, which is when growth did very, very well, right? Extremely low interest rates. When interest rates are low, you're willing to wait for earnings down the road, right? You're willing to invest in kind of moonshot projects or some of these like growth or technology companies that don't have earnings yet today, but hey, they've got a great story to them. Well, today, interest rates are much higher, and that's not an environment, especially with inflation staying high, for a huge rally in these tech companies. Which even today, after the big sell-off, if you look at like PE ratios over time, they still have PE ratios above like the long-term average. Now, hey, there's some good arguments why that should still be the case, but overall, I think for a huge rally to happen in tech stocks, we've got to see interest rates durably trend back towards, let's say 1-2%. And I don't think that's going to happen until the inflation situation is solved. And so really it's all about cash flow today instead of cash flow in the future right now. That really pushes me more towards like value stocks, defensive type investments, companies that pay dividends, right? And by the way, hey, those have lower PE ratios and they're going to have less volatility when interest rates are bouncing all over the place. So I don't think it's time yet to dive headfirst back into the tech world with regards to investing. There will be a really good opportunity. I think we're just not in it yet. We got to get through this inflation situation and recession first.
Okay, great. So yeah, it does look like that was our final question. So we're going to end with our disclaimer, as we always do, which is all investments involve risk, including possible loss of principal. So this material is provided for educational purposes and intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy, and it does not constitute legal or tax advice. Bryce, thanks very much for your time. We really do appreciate it, everybody. We appreciate you coming and you participating here as well. And again, look forward to us again coming back in March with our Secure Act 2.0 webinar. We look forward to seeing you then. Thanks very much, everybody. Have a great day.
Thanks, everyone.